So notice, just to point out that the loan payable that we're looking at is here, the loan payable, and the interest payable is 73. Now, because it's in a separate account, we could just tell them, hey, look, just don't touch the $73, and we're going to make another adjustment for it for any accrued interest as of the next accounting period, and just record your normal loan as you normally would, because the 73 isn't part of the loan balance, and they could still just tie this out to the loan balance. But it's still kind of ugly because they got this 73 and they're going to be like, where did that come from? So we can reverse it. So let's go ahead and just reverse it and say this is going to be for the 73. And we'll just reverse it as of the first day after the cutoff. So this is going to be negative of that. And then the funny thing is, over here on the income statement, we got interest expense, which is going to be, I'm going to say, negative of the 73. Wait, no, positive of the 73. So that's why it's funny, because usually the expense brings down net income, which we've been represented with a negative, like an interest expense here. This time it's going to be a positive. So that means that the accounting department still might be a little confused, because they're going to go, hey, look, I ran the income statement and I've got $73 as a positive expense, which is going the wrong way, because normally expenses always go the one way. It's the analogy of the car. How far can I drive in a day? It always goes up until we reset the odometer. So in this case, you got to go in the wrong way. And it's like, well, yes, that's true. And that's because we're reversing the last transaction. It will be correct when you record the interest expense, because when they record the interest expense, they're going to record the full amount, which is the 140 or whatever, right? The 73 times 2. And so they're going to record a negative double that amount. And if you net the two out, it will then net out to the proper amount of $73, right? So that's going to be that's the proper amount that should be recorded in the current time frame. So that's the idea of it. Now you might also say, well, look, you're not going to do the reversing entry until the 15th of January, because that's when the payment is due. So it would actually be a little bit more correct if you didn't reverse it until the January 15th, and then those two things would match out on the same day that they make the payment. So why are you doing it on 3/1 when you'd have 15 days of more correctness and not have this negative amount if you posted it as of the day they're going to make the payment, which is January 15th. And the reason is, we're saying that'll get confusing because now we're not going to be able to find all the reversing entries. If we scatter the reversing entries across the month, then when we look and try to run a report for the reversing entries, it's going to be difficult. We want to clearly identify the adjusting and reversing entries, and therefore all reversing entries are going to be on the first day of the following month, which will then shore up at the end of the month or whenever we do the next adjusting entry. So that means we have 15 days that we're sacrificing. We're saying, hey, it's not going to be perfect for these. You can have this ugly $73 looking funny going the wrong way, but we're able to find the reversing entry clearly, and we know that it will be correct as of the time you make the payment, and or make the process as easy as possible until we do the financial statement adjusting entries again next year or month or quarter or whenever we do them. All right, that's the idea. So let's go ahead and put some zeros across the board. Zeros across the board. Zeros across. Oh, not there. Not there. All right, it's okay. I can reverse it. I fixed it. I fixed it. Don't panic. I can fix it. I know how to do stuff. And then I'm going to underline this. Let's go to the Home tab, Font Group, Underline. And then we'll bring down the balance. Let's see if we're in balance thus far. Selecting these items, pulling them down. So their liabilities went down, equity went down. It's a classic reversing entry because it was a classic adjusting entry, meaning there's an income statement component to it. It's a timing difference. So we'll sum these up and then copy this. Oh, that's a copy. And then we'll scroll on over and paste it with just the formulae. All right, so there we have it. So now we've got, let's pull down the formatting on the signs. And so there, now we have, again, this kind of funny bit sitting out here with the positive 73 in the income statement, or like an expense going the wrong way, but that's cool. We're cool with that. We're ready to explain the rationalization or why we're doing that with the bookkeeping or accounting department when they ask that question. And then that looks good. We're going to underline here, put an underline, home tab, font group, underline, and there we have it. All right.